In addition, the Federal Reserve Board has been pumping hundreds of billions of dollars of new liquidity into the financial system. And the impact on its balance sheet is very dramatic. The Federal Reserve balance sheet in early September was $800 billion. Tonight, it's over $2 trillion. And by Christmas, it could be at $3 trillion. This is an unprecedented expansion of the central bank's balance sheet because Ben Bernanke believes he is fighting the possibility of another Great Depression. When he was an academic at Princeton 10 years ago, he wrote many books about the history of the 1930s. 6 years ago, the University of Chicago hosted a 90th birthday party for Milton Friedman. We had a whole day of papers and seminars about Milton Friedman's role in the history of economics in the 20th century. And Ben Bernanke was then a newly appointed Federal Reserve governor, and he came to give his luncheon speech. He devoted that speech to what the Federal Reserve Board had done wrong in the 1930s, how it failed to inject liquidity, how it raised interest rates in 1931 to protect the value of the dollar, at a time when the U.S. had 500 bank failures every month, how it failed to play an effective role as lender of last resort. And at the very end of his speech, he turned to Milton Friedman and said, because of what we have learned from your writings about the 1930s, because of what we now know about those huge policy errors 75 years ago, I'm here to promise you today we'll never again make those mistakes. And the history of U.S. monetary policy in 2008 is Ben Bernanke carrying out his birthday promise to Milton Friedman. Ben Bernanke truly believes he is fighting the risk of a new Great Depression. Second big policy change was the Congress and the President agreed in February to give the American people a tax rebate program in May, June, and July. It was worth $110 billion. They also increased the value of business appreciation allowances by $50 billion. Now, these tax rebates weren't very effective stimulating the economy because they coincided with the price of gasoline going to $4.20 a gallon. But if we hadn't had the tax rebates, that big gasoline price increase might have pushed us into recession back in May and June. But because we had the tax rebates as a cushion, as a shock absorber, that sustained economic growth through the second quarter. Thirdly, we are now implementing a plan that Hank Paulson persuaded the American Congress to enact about 5 weeks ago. This is a $700 billion rescue program for the American banking system. When Paulson got the program through Congress back 6 weeks ago, he said he would use the money to buy bad assets from banks, to buy the toxic waste, the troubled mortgages, the very deeply depressed securities which had caused the big losses in the year before at Merrill Lynch, Citibank, and UBS. Since that time, he's changed his mind. He's now used about $300 billion of the money to bolster bank balance sheets through equity capital injections. And he'll probably keep doing that over the next few months. He's also announced overnight he now wants to use this money to buy asset-backed securities for consumer credit card loans, things like that, because he's very concerned about this wholesale collapse going on right now in consumer spending. But they haven't yet defined exactly how they'll do it. So now this program, rather than buying toxic waste, is going to be buying the preferred stocks of dozens and ultimately hundreds of banks around America that have potentially large loan losses and could, because of these loan losses, become undercapitalized. The total equity capital of the U.S. banking system is $1.3 trillion. So if we still have several $100 billion of write-offs to go in the year ahead, that could cripple the American banking system. It could, in theory, wipe out 20 or 30% of U.S. bank capital. So that is a danger, and these capital injections by the Treasury are designed to prevent a major crisis from developing as a consequence of banks losing their capital. Fourth policy change has been a bill that Barney Frank got through the Congress back in June and July. This is a bill to have the Federal Housing Authority provide $300 billion of insurance for subprime mortgages that might go bad if the bank will write the mortgage down to its new nominal market value. What this would mean is that a bank would look at its borrowers and its customers and see which ones might get in trouble, then write the mortgage off by 20 or 30% and give the saving to the borrower, hopefully preventing that borrower from then going into default. And the plan would then be The government would insure the mortgage at that point to guarantee the bank would never again have a loss. We have a first hint last week of how this might work with Bank of America. They bought Countrywide back in July, one of America's biggest mortgage lenders. In the last year, many attorney generals around America have been suing Countrywide, alleging it engaged in predatory lending. It did reckless and irresponsible things with low-income people that guaranteed they would default and get in trouble. BFA agreed to give $9 billion of reductions in mortgage principal to 400,000 borrowers at Countrywide. If BFA is making big reductions in the value of the mortgages like this, then the loans they still have on their books might in theory qualify for this FHA insurance program. This is the only program we have so far which is focused on the borrowers. This is not helping the banks. This is trying to help the people who actually have the mortgage and might default because of falling house prices. And the goal is to basically reduce the number of defaults. Right now, house prices in the U.S. are down 18% from the peak of 2 years ago. And in the formerly hot markets of Miami, Los Angeles, Las Vegas, and Phoenix, prices are down 30%. And the risk of default is very high in these highly depressed markets because people now have mortgages that are worth potentially 20 or 30% more than the value of the house. And the futures markets are projecting the price decline is not over. We have now the Chicago Mercantile Exchange a futures contract on house prices. That is projecting in the year ahead a further decline of 8 or 9% in the national house price index and 15 or 20% for the hot markets, Miami, Los Angeles, Phoenix, Las Vegas. So there is the risk we'll have in the year ahead more and more defaults. And indeed, right now, we have 1.5 million Americans in the midst of foreclosure. And if they all do foreclose, if they all do lose their homes, this will increase the supply of unsold homes quite dramatically. Right now in the U.S., we have 2.3 million vacant houses. But that number could easily be, in a year's time, 3.5 or 4 million because of the high rate of foreclosure and default now going on. The final policy response to the crisis has been global. It's been occurring over the last 6 or 8 weeks since the Lehman bankruptcy. We've had very dramatic policy changes all over the world. In the United Kingdom, Her Majesty's Treasury announced a program in mid-October to rescue the British banking system. They're providing $50 billion of equity capital to major banks and guaranteeing £300 billion of British bank liabilities. And so far, 2 major banks have taken up this capital, Royal Bank of Scotland and Lloyds Bank, which is in the midst of a merger with the old Bank of Scotland. Royal Bank of Scotland is now 60% owned by Her Majesty's Treasury in London. This was, a year ago, one of the world's most aggressive banks. It launched a big takeover bid a year ago for ABN AMRO in Holland, broke the bank up. It was a very, very aggressive bank, very aggressive lender, and now because of this crisis, it's basically controlled by the British government. It's no longer truly independent. The German government also intervened to provide a €40 billion credit for a major real estate lender in Munich called Hypo Bank. The governments of Holland and Belgium nationalized the Fortis Bank, also a bank that was involved in a takeover bid for ABN AMRO. Subsequently to that, they sold the Belgian division to a big French bank, BNP, while the Dutch government retained ownership of the Dutch branch of Fortis. The Dutch government also gave $10 billion of capital to ING, a major Dutch insurance and banking group. The French government's injected about €10 billion of capital into their banks. Ireland agreed in the middle of the crisis to guarantee all of its bank deposits. Other European countries protested, but within a week, Germany and Greece did the same. So did the governments of Australia and New Zealand a few days later. So we've had a very dramatic global policy response to this crisis as well. These are truly unprecedented levels of intervention by governments to try and rescue the banks, prop up the financial system, and guarantee that we don't have any more major bank failures.